All right, everybody, welcome back to a Teaching Tax Flow live session. Q&A a little bit in this time. We are holding, just a little disclaimer, we are holding off on questions a little bit more in this one. If you're joining us live, there's a ton of content to go through. So if you have any questions, we did take a handful of them we're going to run through. Be sure to shoot them over to us. You can go to that Defeating Taxes private Facebook group, send them that way, or shoot us an email at hello@teachingtaxflow.com. We'll be sure to answer them either directly or get them into the next session. So now that we got that out of the way, today we're going to talk about some tax-related topics when it comes to parenting, right? So if you're not sure what that is, I can tell you as a parent of a 4-year-old toddler at home, they're a little taxing on their own. So needless to say, we're going to talk about putting some more money in your pocket by taking care of those little ones. So maximizing credits and deductions today, we are going to talk about, but brought him back on here again with me. Probably a familiar face to many of you, Chris Picciurro. Welcome back, sir. How you doing?
I'm wonderful. How are you doing?
Hey, I'm doing pretty good, man. I'm doing good. I'm excited about this topic, as I am pretty much everything else we do. I think we always say that too, because we vet each other's content ideas. And if we don't like them, we take them pretty quick. So this is a good one. Right. So let's get into this. I know we got 10 of them that we need to power through, that we've kind of slimmed things down to. So I will let you kind of drive the ship here a little bit. Again, I'm going to be monitoring some questions that are coming in as they come in. If they're related to something that we're on that topic already, I'll be sure to throw them your way. So without further ado, sir, the mic is yours.
All right. That sounds great. Yeah. Let's talk about tax savvy parenting. And as you said, we have 3 children, 2 teenagers and an 11-year-old, going to be 12, coming up here soon. So we've been through that infant, toddler, tween, teen stage. And you are correct. They are taxing, but how can we benefit tax-wise through credits and deductions? We know the tax laws are written to encourage, discourage certain behavior. There's certain things available to taxpayers with children, that we're going to talk through. So the first one's going to be the CTC, most common tax credit for parents of teen-age children or younger, and that stands for the child tax credit. So we're talking about the 2024 tax year this year in this webinar or masterclass. And yeah, the maximum credit amount is $2,000 per qualifying child under the age of 17. It's funny teaching luckily all over the country, and even to other fellow tax professionals, we kind of chuckle when it says, why doesn't the IRS just say up to 16? I don't know. So the child's age on the last day of the year is what their age is for the entire year when we talk about qualification. I should have said that. So if you're under the age of 17, the maximum child tax credit is $2,000. We talk about refundable and non-refundable credits. Remember, refundable credits mean that even if you don't have tax due, you can get that money back. Non-refundable means you have to have that amount of tax to get the credit. And up to $1,800 of that $2,000 is non-refundable. There are phase-out limitations based on your income. So that is $200,000 or more for single people. You start phasing out and potentially completely out of this tax credit. $400,000 for married filing jointly. The child does have to be your dependent, has to meet residency tests, and live with you for more than half of the year to make sure that you can obtain that child tax credit. So that's the CTC. That's number one most popular.
And Chris, on that one, we did just have a question. So the 200 and the 400, I believe what it was you mentioned, but for phase out, basically at that phase out, so at that threshold, they get no benefit to that credit, correct? Or is it incremental over that?
Yeah, it's an incremental phase out. Yep. It's an incremental phase out where so you've got to look at your, what's called modified adjusted gross income, or MAGI. So, yep. Now, number 2, child and dependent care credit. Now, this is a credit available for working parents. So if both parents have earned income, let's say if you're married filing jointly, you can get a credit for child and dependent care. John, I know you guys take advantage of this. It's up to, you can claim up to $3,000 of expenses for one dependent, up to $6,000 for 2 or more children. So if you have 4 children, the maximum amount of eligible expenses is still $6,000 for the child and dependent care credit. And you get a credit of somewhere between 20 and 35% of your expenses based on your income. So let's say you have one child, you have $5,000 of expenses, okay? The first $3,000 of expenses are eligible for the credit, and the maximum credit's 35% of the $3,000. So that's how that works. So it could be a very beneficial credit. Remember, if you have 2 or more children, the maximum amount of eligible expenses is $6,000. It's not $3,000 per child you have. It's $3,000 for one child, $6,000 for 2 or more children. This includes daycares, babysitters, after-school programs. Now, the child must be under 13 years old to claim this credit, or disabled, okay? And married couples must file jointly to obtain this credit, and this credit's available to unmarried taxpayers also. But if you have a married filing joint return, both spouses have to have what's called earned income to obtain that credit. And another tip is make sure that you have the name, federal identification number, and address of all of your daycare providers or babysitters or whatever to get this credit. So if you go to, let's say your child goes to a day camp where they're, during the summertime, you're going to need that information, because what I see a lot of times, one, taxpayers wait till the end of the year and they say, oh my gosh, yes, we used this after school program, and they have their tax return prepared. And guess what? They can't find the federal identification number. Or worse, you might have someone that maybe isn't the best taxpayer that watched your children, and now they refuse to give you their social security number. So definitely obtain all that information before you pay them, so you have that for tax return filing. So that is the dependent, the dependent child and dependent care credit.
Excellent.
Number 3, a lot of people in our industry call it the EITC. That stands for the Earned Income Tax Credit. So this is a tax credit specifically designed to provide extra, it's a refundable credit, but extra money in the pocket of some of our lower income households, okay? So the maximum credit for the EITC, or Earned Income Tax Credit, for families with 3 or more children. So 3 or more children is over $7,600. However, there's a limit of amount of income that you can have. So for example, married couples with 3 children have to have less than $60,000 of income, and you can't have what's called investment income. So let's say you're just working, at a W-2 job with $40,000 a year, but you have $20,000 of net rental income. Even if you have eligible children, you're not eligible for that credit. So that's something to consider. Now, when you think about the earned income tax credit, I want you to think that the credit, this is kind of complicated because it works like a bell curve. It works where if you have a certain amount of income, you get a little bit of a credit, then it peaks out, and then it phases all the way down. And that credit there's way too many nuances to go into it on this, in this recording, but I want to tell you the factors. 1, your filing status. 2, the amount of eligible children that you have. And 3, your income. And those qualifying children do have to meet the relationship, age, and residency tests outlined by the IRS. So this could be a very valuable credit, especially for those lower or modest income households. So yeah, it's pretty interesting. Number 4, the adoption tax credit. So the adoption credit is very, very generous. For 2024, the maximum adoption credit is over $16,000 per child. And there is a phase out for taxpayers with that MAGI, modified adjusted gross income, of over $241,000. So if you have over $241,000 of adjusted gross income, this adoption credit starts to phase out. But so the maximum is very generous at $16,000, and the credit is non-refundable, meaning you can only offset your tax liability. But the unused amounts do carry forward for up to 5 years. So you might not get. So let's say you get a $10,000 child tax credit and your tax is $3,000. You get to wipe out that $3,000 worth of tax in 24. You get to carry forward the $7,000 on your tax return. That's why it's so important when you're working with a tax professional to make sure that you, if you are changing your tax professional or even changing software, if you're self-prepare, to make sure you have those previous year's tax returns available, because there's a lot of things on those previous year tax returns that can help you in this year. I want to talk real quick on two things about the adoption credit as well. Eligible expenses, right? So that includes court costs, attorney fees, and travel costs. Those are the main examples of expenses. And finally, where do you report this, right? Well, this credit does appear on your personal tax return, which is Form 1040. However, the credit is claimed on a Form 8839. So there's a special form for qualified adoption expenses that lays out what is eligible for the credit, and we calculate the credit, and then we make sure that, again, remember, it's non-refundable. So if you have that amount of tax, you can offset that tax and carry forward any unused credit for up to 5 years. And John, I'm just going to say, it's very common to have qualified adoption expenses carry forward. Well, why? Well, if the phase out for getting this credit is at $240,000 and the maximum credit's more than $16,000, it's very likely that a person, let's say their household income is $80,000, they're not paying $16,000 or $10,000 in federal tax. So that's where you're going to see it's common to see that phase out.
So we do have a question with this, and I think you answered it previously, and I apologize for not writing it down if you did. But so there's a cap on the credit, which is right about $16,660, I believe you mentioned. That's per child. So the first part of this question that they asked was, there's no cap on the number of adoptions, so the number of children, correct?
Well, you could have multiple. Yeah, you could have multiple children adopted.
Mm-hmm.
However, there's somewhat of a cap, because let's say you adopted 10 children, you have 5 years to use all of the credit. And if your income is more than $241,000, you're not going to get the credit anyway. But to answer the question, yes, you can have multiple children eligible for the adoption expenses.
Perfect. Yeah. And then the other part of that, it's I could be wrong, but it's a little bit self-explanatory, but I'm glad it was asked, is say their adoption expenses were 20, 30, 40,000. You can't carry those forward to another year and then take another credit on that. It's the allocated credit is per child. So basically per Social Security number.
Credits per child. That is correct. All right. So let's look at the next thing. So we've gone from the child tax credit to daycare credit, what we call it, and to the adoption credit. And then we also hit the earned income credit. Now, instead of having those little ones, let's talk about educational tax benefits, okay? Educational related tax benefits provide parents relief for their kids in school or college. So you have a few different options here. The first option you have is an AOTC. That stands for American Opportunity Tax Credit. And that credit is a maximum of $2,500 per student for their first 4 years of post-secondary or after, let's say, high school or after they get their GED education. Of the $2,500 per student, up to $1,000 of that credit is refundable. And remember, the other $1,500 then would be non-refundable. So the AOTC, when you're talking to people about college credits, that's the better of the two college credits, right? That's the one that's more generous. You also have another credit called the LLC. Now, this is not a limited liability company. We're not going to go down that road. It's the lifetime learning credit. So once you utilize those first 4 years of post-secondary education and utilize that AOTC, then you can move on to the LLC, lifetime learning credit. Now that gives you up to $2,000 per return credit for qualified tuition and fees, with no limit on the number of years you can claim it. So there's no limit, but it's $2,000 per return, where the AOTC is $2,500 per student. So those are whenever you're working on tax planning, or if you're a tax professional preparing returns for parents with college-age children, you're going to want to really look at the AOTC and the LLC, those two educational tax credits. I would be remiss without mentioning 529 plans. We have a lot of content in Teaching Tax Flow about that. I'm going to spend less than a minute on that. Here's what you need to know about 529 plans or college savings plans. One, they've become much more flexible as far as use. Two, it's our gold diagnosis in Teaching Tax Flow, so it allows you to put money away and let it grow tax-free if it's used for qualified expense, just like a Roth IRA, and there's no income limitations. And some states actually provide you with a deduction for a 529 plan contribution. So definitely if you have younger ones, look at that 529 plan. John, I know you and I both use that for our families, and it's become very useful for us.
Yeah. And if anybody's interested in listening to a podcast, we have multiple that we've done on 529s. You can actually just Google, or you can Google it if you want to, but go anywhere that we have the Teaching Tax Flow podcast. Be sure to subscribe while you're there. But you can just search in the title of really where you're at and just put in 529. So 529 plan, and you'll get probably 3 episodes where we've mentioned it. They're pretty cool. I think the biggest takeaway from that, Chris, that I was surprised to learn is that you don't have to have a 529 in the state that you reside in, correct?
That's absolutely correct.
Mm-hmm.
Yeah.
And different states have different benefits.
Plan sponsors, right? Different plan sponsors and that sort of stuff. So talk to your financial advisor as well. Jump into Defeating Taxes, defeatingtaxes.com with questions. And if you're looking for a referral, let's talk about something that's not very fun, medical expenses. So we know that it's sometimes hard to deduct your medical expenses. We have other content. We have whole podcasts on medical expenses. And if you itemize your deductions, you can claim the medical expenses that exceed 7.5% of your income. That's nothing new. However, this is what's interesting. The medical expenses are for your entire household. So that includes your dependents. So a lot of times we think as parents what our medical expenses are, but any expenses for our family members that are dependents are included in that calculation of adding everything up and figuring out what amount is over 7.5%. And if we itemize, that includes doctor visits, prescriptions, therapy sessions, especially with parents with special needs children. Those expenses could add up very, very quickly. So it's not just visiting the doctor. If you're required to have special medical equipment or specialized education, those expenses can add up a lot. I know my wife is a special education teacher by trade. So, a lot of times the students that she's working with within the school have several different types of expenses outside of the school that those parents are incurring, and maybe can receive a tax benefit from that.
So pretty much that includes anything that's out of pocket, that qualify out of pocket expenses.
Yes, correct.
Awesome.
So let's talk about filing status, number 7 in our list. And this will be pretty brief, but we know that if you're married, whatever your filing status is, the last day of the year is your filing status for the entire year. So if you're married at the end of the year, you're either going to file married jointly, which makes you eligible for most expenses, or married separately. If you're single, you're going to file single. But single parents often qualify for a special filing status called head of household. A head of household is kind of a hybrid of married, joint, and single. And for head of household, you get a higher standard deduction. That's $21,000 in 2024. And you have wider tax brackets than that of someone that's single. So to qualify for head of household, you have to pay for more than half of household expenses, and you have to have a qualifying child or dependent that lives with you more than half of the year. So if you are a single parent and you really want to make sure that you're taking advantage of head of household if you're eligible. I've seen tons of returns over the last 20 plus years where they've come into our private practice. We've looked at them, talked to the parent, and we've said, you know what, everything looks great on your prior year return, but you filed as single. You didn't file as head of household. And if you're filed as head of household, it would reduce your tax. So definitely take a look at potentially being head of household if you are a single parent. Now, on to number 8, the premium tax credit. So for those of you that have purchased health insurance through the marketplace, you might qualify for the premium tax credit. Remember, when you purchase health insurance through the marketplace, you're self-certifying your income and you get a subsidy for your health insurance. So if your health insurance is $500 a month and you self-certify your income as a certain amount and you get a subsidy of $50 a month and your income falls. When you prepare your return, the tax return reconciles this. And if your income falls lower than what you self-certified, you actually could receive a credit. So in other words, if you were supposed to get a subsidy that's higher than you received, you get that on your tax return as a premium tax credit. To get this, your income does have to fall between 100% and 400% of the federal poverty level. And that is based on your household size. So just be aware, if you're thinking about this, if you are using the marketplace for your health insurance, make sure you take a peek and see if you're eligible for that premium tax credit. Now, it could flip the other way. There could be a payback if you receive too much credit and your income's higher than you self-certified. But that's not this episode. That's not this, this session. This session is tax savvy parenting, and that wouldn't be very savvy. So we'll move on to number 9 of 10. This is where things get a little sticky. Not every household is a perfect white picket fence, 2.5 kids, and a well-behaved dog, right? Tax rules for divorced or separated parents. I mentioned that your marital status the last day of the year is your marital status for the entire year. Now, you could be legally separated, which means that for at least 6 months of the year and file single or head of household, not married filing separately, because married filing separately is pretty much the worst filing status, for lack of better terms. So divorced and separated parents really have to follow specific rules for which parent can claim child-related tax benefits. The custodial parent, so the one that the child resides with the majority of the time, generally claims the child-related tax benefits. However, a custodial parent can release that dependency exemption to a non-custodial parent if it's agreed to. So that's where, if you're a tax professional or if you are or just a taxpayer, you really want to look at those custody agreements, potentially divorce decrees, to lay out who gets what as far as claiming children and tax credits. If the custodial parent decides they're going to release the dependency exemption, which could be for a variety of reasons that go beyond the scope of this this recording, you file a Form 8332. It's extremely common for this to happen. So Form 8332 is where a custodial parent basically releases or provides the non-custodial parent the tax benefits of claiming the children. And it could be a variety of reasons. It could be more beneficial for the non-custodial parent to have those credits and deductions.
Awesome. And I think you said we have 10, right? So on to the final one.
Final one is kind of a catch-all, okay? And they're just additional tax-saving tips. Why? Well, as you've listened to many of these tax credits and deductions, there are things called phase-outs. A phase-out is based on your income. Well, you can control your income to an extent by doing some tax planning, because you don't want to get phased out of some of these credits that you could be simply eligible for. So I'll give you a couple. One is going to be the dependent care FSA. So you could, instead of taking the child tax or child care credit, you could, if your employer is eligible, has an eligible FSA or flexible spending account, put up to $5,000 pre-tax in through your W-2 into this FSA, and use that money to pay for for child care. There's no income phase out there. The other thing, my second tip, is think about making retirement plan contributions, because retirement plan contributions reduce your income, which could make you more eligible for credits.
Awesome. And when you say retirement plan contributions, are you talking IRAs, 401ks? What exactly there?
Yeah, so it's going to be IRAs and 401ks for the most part. Now, you might have a SEP, you might have a 403b, but any type of retirement plan could be beneficial.
Awesome. Well, I know we kind of fielded a lot of the questions. I shouldn't say fielded. We got a lot of the questions, but we held off on answering some of those again, just to kind of power through these. Again, as I mentioned at the beginning of the show, send us an email, hello@teachingtaxflow.com. If you had any questions we didn't get to, shoot them that way. But even more importantly, if you are looking for any introductions to anybody, specifically for things, that's a resource. Check out our Facebook page, YouTube channel, everything for Teaching Tax Flow, tons of content. But we'll offer this to you too, which we usually don't do, Chris. If anybody was actually listening to this very attentively and your handwriting couldn't catch up with your ears, shoot us that email. We'll send you a copy, basically some cliff notes, if you will, of the show. You can have it in front of you, print it off, put it on the fridge, give it to your spouse. Heck, give it to your kid and say, listen, this is how much you cause us issues. We're going to solve them. So have some fun with it. But again, we are here as Teaching Tax Flow as your resource partner with anything tax related. We look forward to seeing everybody again here very soon. And, we like to do these sessions. So if there's a topic that we haven't discussed on a podcast, anything else, shoot us a message. We love to throw it on the board. So until next time, everybody, enjoy it. And again, we're here if you need us.